Let's jump right into this. We are looking at a massive, literally make or break scenario unfolding for global gold and silver markets right this second. It's the kind of collision that could completely change the rules of the game in real time throughout this explainer.
Look, we have exactly 24 hours. That's it, 24 hours until some serious, ground-shaking volatility could hit the markets. We are sitting in this hypercritical window where two massive tectonic forces in global finance are just about to collide. Any calm you might be seeing on the charts right now? Yeah, that's just the deep breath before a major market reaction.
We are on a direct collision course here. On one side, we've got a staggering 31-year record move that just dropped out of Japan, and on the other, an impending, incredibly high-stakes decision from America's Federal Reserve. One of these forces has the sheer power to give gold wings in the short term, while the other could trigger a notoriously painful market sell-off. Let's break down exactly how these two distinct global forces are interacting, and more importantly, why it matters to your portfolio.
Let's start over in Japan. You guys know the drill. For years, Japan has been the global land of zero or even negative interest rates. I mean, from 2016 all the way to early 2024, their rate was literally stuck at negative 0.1%. Keeping money in the bank basically costs you money. But in a two-day meeting that just wrapped up, they totally jolted the market. They jumped their short-term policy rate to 1%. Now, 1% might not sound huge to us, but for Japan, that is the highest interest rate level they have seen since 1995.
And what's frankly just wild about this whole thing is the sheer desperate urgency behind the decision. This wasn't some casual wait-and-see kind of move. The Bank of Japan's Monetary Policy Committee pushed this aggressive hike through with a dominant 7-1 majority vote. And get this, they passed this urgent vote even while the Bank of Japan governor, Kazuo Ueda, was literally admitted to the hospital. No way they were hitting pause. They took this historic step right then and there because they knew the situation was at an absolute breaking point.
So how did Japan get backed into such a crazy tight corner? Well, it really comes down to a classic domino effect. You've got heightened geopolitical tensions in the Middle East driving crude oil prices up, hovering dangerously around that $90 a barrel mark. And since Japan imports practically all of its oil, those sky-high prices create crushing imported inflation. Actually, you have to go all the way back to the 1970s oil shocks to see Japan hurting this much from imported inflation. This whole dynamic just completely devastated the Japanese yen, pushing it past the perilous 160 mark against the US dollar. The government tried dumping billions from their forex reserves to save it, but it totally failed. They literally had no choice but to act on interest rates.
Now, you might be wondering, what does a local banking decision in Tokyo have to do with your global gold investments? To get that, we have to talk about a foundational liquidity concept called the carry trade. Basically, a carry trade is just borrowing money in a place where interest rates are dirt cheap, like Japan, and taking that cash to invest somewhere else where the assets yield a much higher return. Simple, right? The really crucial point here is how simple yet absolutely massive this business transaction is. Imagine you're a heavy-hitting international investor. For decades, you could borrow practically free money in Japan, say a massive loan of 1,000 crores. You take that essentially free cash, walk right out of Japan, and safely park it globally into US markets or stable assets like gold. You comfortably scoop up a 6 to 8% return on that money without breaking a sweat or taking on huge risks. It has been this massive, highly profitable engine pumping liquidity across the globe.
But here is where the trap totally springs shut. With Japan unexpectedly hiking rates to 1%, they've effectively turned off the tap of free money. Suddenly, all those global investors, they are facing real, actual borrowing costs on those massive loans for the first time in forever. To cover these sudden new costs and pay back their Japanese debt, these funds might be forced into a frantic, massive sell-off of their global assets. That means dumping shares and liquidating gold holdings just to scrape together the cash.
And this is exactly why traders around the world are absolutely sweating right now. History is flashing some major warning signs. Historically, whenever Japan tightens up its monetary policy and disrupts that sweet flow of cheap global liquidity, dangerous market corrections almost always follow. I mean, we saw massive global fallout line up perfectly with the bursting of the dot-com bubble back in the year 2000, and again, leading right into the Great Recession in 2007 and 2008. When Japan shakes the interest rate tree, the whole world feels the tremor.
But wait, Japan is only half of this whole global collision story. Let's pivot over to the US, where sticky CPI data coming in at over 4% is putting the markets on absolute high alert. The latest consumer price index numbers are showing us that inflation in America has proven to be incredibly, frustratingly stubborn. It is just not dropping the way economists, or the government for that matter, had hoped. And this incredibly sticky inflation, that is exactly what's setting the stage for our 24-hour countdown.
Because of that stubborn data, the U.S. Federal Reserve is staring down a brutal, high-stakes dilemma. They're getting these totally mixed signals from the labor market while fighting this inflation monster at the exact same time. So what do? Do they take the dovish path, meaning they cut rates to stimulate the economy and save us from slipping into a recession? Or do they take the hawkish path, holding rates high, maybe even raising them to finally crush that sticky inflation down? I'm telling you, they are walking a razor-thin tightrope right now.
This fork in the road, it literally means everything for the markets right now. Let's look at Path A. If Fed Chief Kevin Warsh signals that cuts are coming because the economy is cooling down, the US dollar is going to weaken. Investors will likely yank their money out of traditional banking and just flood into gold, potentially sparking an absolute record-breaking bull run. But then, look at Path B. If those sticky inflation fears went out and they signal rates have to stay high for longer, we get a super strong US dollar. And as we all know, a strong dollar almost always triggers heavy profit booking and a brutal sell-off in gold.
So here we are. We're at a monumental crossroads. We are looking at a true, literal, make-or-break scenario for global traders. With Japan's shock move already putting immense, heavy pressure on global liquidity, every single word spoken in the upcoming Fed press conference is going to be intensely scrutinized. I mean, every single sentence has the potential to be the spark that sets off massive global volatility across both the gold and silver markets. The entire global financial architecture is shifting right under our feet as we speak, and the outcome over the next few hours is going to set the trend for months. So looking at all this data we've covered in today's explainer, I really want to hear your take. What's going to happen? Will the US blink, cut rates, and trigger a massive gold rush? Or will they stay hawkish, keep those rates high to fight inflation, and